Well, thank you guys for attending tonight's seminar. So we better kick off. I kind of religiously always like to start on time. You guys are courteous enough to be here on time. I'll repay the courtesy and start on time. For those that are online, I've got a crowd of people in front of me. So I am a bit of a hybrid presentation where we've got people in front of me and people online. So I'll try to be conscious of that and move forward with the presentation. So my name's Augusto Hernan-Rees. I go by my middle name, Hernan. We've also got Therese Pontifex, who you saw downstairs. We're both financial planners. Therese has recently been brought on board as a second in-house NES financial planner. We have offices here in Chullora, and we also work from Market Street. There are details on this particular slide. A little bit of housekeeping for those that are here attending in person, that we're going to keep all the questions to the end of the seminar. So at the end of the seminar, I'll log off online and then come to the table, guys, and answer any questions you may have. So just please bear that in mind, that we'll leave questions to the end. With all seminars, we must provide a disclaimer. So please remember that the material provided is general information only. It is not based on your personal situation, objectives, and needs. Before making a decision, you should assess your own financial situation, objectives, and needs, and if necessary, consult someone such as myself or Therese. We're both licensed financial planners. You should be aware that all investments carry risk and that past performance is no indication of future returns. What are we trying to accomplish in our NES Super seminar tonight? We would like you guys to walk away with a better understanding, knowing exactly what super and super pensions are, knowing how taxation is affecting you and your retirement plans, knowing how Centrelink means test works, knowing the different assets you can invest in now in retirement, knowing if financial planning can add value to your situation. I always felt, guys, that in the context of a professional seminar, that you should walk away with a better understanding of super than when you walked in. Been doing this for 23 years. That remains my mission every time I'm in front of an audience. At least that's my hope for tonight. What is super? Also known as superannuation. I always felt this should be the first question one should have answered when they attend a superannuation seminar. In my experience talking to members, it's one of the least understood subjects. So, what is super? The answer is nothing more than a place to store your wealth. Now, that may sound simple, and the truth is that it is and will remain simple. Of course, things get more complex, but never lose sight of the fact, never lose sight of this slide. Super is a place to store your wealth. So what is a superannuation pension? And how is it different to a superannuation fund? The answer is a super pension is nothing more than a place to store your wealth with a valve, faucet, tap, drip feed facility attached to it. So a superannuation pension, as opposed to a superannuation fund, deposits regular payments into your personal bank account. That is it, guys. That's the difference between a superannuation fund and a superannuation pension. Now, you'll hear different phrases as far as superannuation pensions are concerned. You might hear transitional retirement pension. The word pension comes up. There are other providers out there that provide different types of pension, defined pensions. But as far as NES is concerned, we are referring to either account-based pensions and transitional retirement pensions. And they are different to a superannuation fund in that they drip regular payments into your bank account. Wealth always needs a place to live, and superannuation is such a place. Most of the time, wealth simply sits in your name. When you invest in cash, fixed interest, property, shares, the bank account, property, term deposit, and shares are in your name. You are where this wealth is held. Look at the deeds to your property, the name on your bank account, or the holder identification number on your shares. They will have your name on them. That is where the wealth is being held. A company is another place that wealth can be held. A company is a legal entity formed by a group of individuals to operate business enterprise in a commercial capacity. It's actually a separate legal entity that has its own powers. As far as the law is concerned, a company has a separate legal existence that is distinct from its owners, managers, operators, employees, and agents. A company has its own rights and obligations. And you can hold cash, fixed interest, property, or shares in that entity. So why store your wealth in super? Given that you have other options, such as holding assets in your name or holding assets in a company. Wish I had a drum roll now. The answer is tax. Tax can be defined as a charge imposed by a government to an entity for public purpose. In other words, the government wants their cut. Here we have a couple again, and they're looking at the most efficient place to store their wealth. They decide to invest in their name. The average Australian is taxed 24 cents in the dollar. So here a couple is of the view that they're earning $1 through their investments, but they're not. The government's taking 24 cents if they're the average Australian. Remember that we don't spend gross dollars before tax dollars, we spend net dollars after tax dollars. What's ever in your wallet or purse right now is an after-tax dollar. The Australian government, Australian Taxation Office, has already received a cut, and and if you're the average Australian, that's around 24 cents in the dollar, which is a pretty big cut. Again, another place in which you could choose to store your wealth is a company. And if you have money invested in a company, and the company is subject to the general company tax rate, the Australian Taxation Office walks away with 30 cents in the dollar. Again, the company might make $1, but you're actually walking away with 70 cents because it's taken 30 cents in the dollar. Our final example of where money can be stored is super. Again, guys, super is simply a place to store wealth. However, every dollar that super earns through its investments is taxed at a relatively concessional 15 cents in the dollar. The superannuation fund tax rate is 15%. It's the most favourable tax vehicle in Australia. A super fund recipient, after ticking a few boxes, would be able to spend 85 cents on holidays and restaurants, which is more money to spend than if they had stored that exact same wealth in their name or in a company. And let's not lose sight of superannuation pensions. Superannuation pensions are even more advantageous than super funds for those that are retired or have hit certain milestones. Remember that a super pension is a super fund that now pours out regular payments into your personal bank account. For those that have super pensions, they often describe it as simply receiving what seems like a salary. When you do transform your super fund into a super pension, and again are retired or have hit certain milestones, the wealth you earn in the super pension gets taxed at my favorite tax rate of all. 0. Rest in peace tax. Superannuation in pension phase is the only legal zero tax structure out there. And just for those that have transitional retirement pensions in the audience tonight or online, keep in mind that they are actually still taxed on earnings at 15%. Our reference here is to account-based pensions. So if you have cash, fixed interest, property, or shares, just to really make the point, guys, and you invest in your name, you get taxed and walk away with 76 cents if you're the average Australian to spend on restaurants and holidays. If you have cash, fixed interest, property, shares, and you have that invested through a company, you get taxed and walk away with 70 cents. If you have cash, fixed interest, property, and shares, and you invest those in a super fund, you get taxed 15 cents, walking away with 85. And if you are retired, over age 65, have hit certain milestones, and your super is in a pension phase, rest in peace tax. 0 tax. Understanding super and super pensions is simply understanding that it is a great place to store your wealth because of the concessional tax environment. That's it. So let's pause for a moment and look at what we're trying to achieve with our seminar tonight. The first outcome we wanted everyone to walk away with was a better understanding of super pensions and super funds. And the answer to those two questions is they simply a very concessional place to have your wealth stored. The second outcome we wanted you guys to understand from tonight's seminar is the taxation characteristics of a super fund and super pension. But let me throw a spanner in the works here. Did you know that although the average Australian is taxed 24 cents in the dollar, as mentioned a few times already in tonight's seminar, there are people in online and even in this room that might be taxed 45 cents in the dollar. Or some people aren't being taxed at all. So you quickly start to see that scenarios can become quite complex. And it's about navigating and balancing these particular scenarios. How do we balance those? The answer is financial planning. Good financial planning is having you determine the destination and me, the advisor, providing the clearest guidance on how to get there. It's my job to actively consider your broader, long-term interests and likely circumstances. It's my job to provide guidance, and it's a service that Nest Super provides to all its members. Part of your membership privilege. Wealth, mentioned a few times tonight, but let's look at it a bit more closely. There are 4 major asset classes. They're cash, fixed interest, property, and shares. They're the 4 major asset classes. Cash, for instance, is what we consider a low-risk investment because there's virtually no risk attached to investing in the asset class. You're incredibly likely to get your expected return because of the virtual no risk. This is often considered a risk-free rate of return, and all other assets are measured in relation to this benchmark. Beyond this, we have fixed interest, which means you lend money out and expect this to be paid back with interest. Fixed interest investments have additional risks to cash, such as credit risk, interest rate risk, and because it has to be held for a period of time, it also has duration risk. To understand this additional risk, suppose you were to purchase a fixed interest investment of $100,000 that matures in 1 year and provides you 3% return, thus walking away with $103,000. What risks are attached to this? Let's just say that same day, the RBA announces an increase of 1% in interest to 4%. Let's just say, for the purpose of this example, that the banks surprisingly pass the 1% additional interest to the consumers there and then. And here you've gone and purchased a 3% at $100,000. And later on that afternoon, the RBA announces a 1% rise in interest, and anyone can walk into a bank and get 4%. The risk lies here. To induce a buyer, you'll have to sell your fixed interest investment at a discount. They can walk into a bank and get 4%, and you, for whatever reason, need to get rid of your fixed interest investment at 3%, you'll actually have to reduce the value of the investment to induce a buyer to buy it off you to ensure they get that 4%. It's an inverse relationship, guys, because interest rates in this example have gone up, but the value of your fixed interest investment have gone from $100,000 to $99,038. Now, the opposite happens with $100,000 invested at 3% if the RBA announces that interest rates are going down. So here you've purchased a fixed interest investment at 3%. That afternoon, the governor, the Reserve Bank governor, announces a 1% decrease in interest rates that are immediately passed on to the consumer. All of a sudden, fixed interest that you purchased earlier on that day seems a lot more attractive. If someone wants to buy it off you, you'd be selling it for $100,980 because interest rates have gone down and you've secured a high interest rate investment. The value of your fixed interest investment goes down because interest rates have gone down. Go up because interest rates have gone down. Property is an asset class that most people understand, and its basic function, it simply provides shelter from storm, rain, wind, snow. It's a means of providing shelter and utilities. That's all property is. The reason this is high up the risk curve is because it has more risk than the other investments mentioned to date. We've all heard nightmare stories about tenants trashing places, or if it stays vacant for a while, you're the one footing the bill. And we're all starting to realize how sensitive property is to interest rate. Again, because you are taking additional risk, the market potentially rewards you with additional returns. But never lose sight of the fact that you are subjecting yourself to additional risks. Finally, the last major asset class is shares. Shares represent equity in a corporation or financial asset owned by investors who exchange capital in return for units. They are literally a stake in the company. So why is this the highest risk of investments? Let's come up with an example. Let's say we have business partners here who've invented the latest and greatest solar panels, which are far more efficient than anything you can get in the market. And now they're in a position to mass produce. As they themselves don't have sufficient funds, they go to the market to look for funding. They literally sell units in their company to investors who provide them with capital to start to mass produce. Shares are considered the highest risk investment because there are so many variations or variables to affect the price. Shares have risks such as volatility risk, market risk, sector risk, timing risks, etc. You can also have a good company but a bad share. if the share is overpriced. With our example, for instance, our entrepreneurs are on a good thing. Their share price is shooting up because they've been able to provide cheaper energy. However, unbeknownst to them, someone's been working on a fusion reactor, and all of a sudden, their means of producing energy aren't nearly as efficient. That's the risk that shares have. Remember, for every blockbuster, there's a Netflix in waiting. Again, because you're taking this additional risks, the market potentially rewards you with additional returns, but again, never lose sight of the fact that you are subjecting yourself to that additional risks. As described above, each asset class has different risk-return characteristics. Everyone has heard of the phrase, the higher the risk, the higher the return, or no risk, no reward. This is one of my favorite graphs in the industry because I think it so beautifully describes what we call the risk-return trade-off. As you walk through each asset class, you can see that you are potentially receiving additional returns, but as you can see on the horizontal axis, you're also engaging in additional risks. Nothing escapes this risk-return trade-off. Again, this graph elegantly describes the trade-off between risk and return with each asset class mentioned. And the higher the risk curve you go, the potential higher returns, but also higher losses that you can subject yourself to. So, which asset class should you invest in? Shares, fixed interest, cash, property? Given all the different characteristics of each of those asset class? The answer is always dependent on your situation, objectives, and needs. Someone who needs their money in a month will invest differently to someone who needs their money in 30 years. Someone who's drawing down on their wealth will structure their assets differently to someone who's accumulating wealth. And where do you hold these four major asset classes? In super or super pension, which are likely to be taxed favorably, or a company, or your own names, without such likely tax concessions. And how do you balance all these questions and navigate through all of this? The answer is financial planning. Again, good financial planning is having you determine the destination and myself or Therese, the advisors, providing the clearest guidance on how to get there. It's my job to carefully weigh each option, communicate my reasoning, and ultimately provide a recommendation in your best interest. At this point, guys, we've been actually focusing quite a bit on the Australian Taxation Office, which I often refer to as the enthusiastic takers of your money. But we are looking at the retirement side of the seminar. And so let's now focus on what I sometimes phrase as reluctant givers, or you might know them as Centrelink. Centrelink is an Australian government department delivering payments and services on behalf of the Australian government. The age pension, a payment provided by Centrelink, provide regular income for people within certain means. The age pension is paid fortnightly. The age pension, more often than not, forms a large part of most people's retirement planning. It's often misunderstood key source of cash flow, which seeking financial planning advice can very much enhance. Understanding your age pension entitlements allows you to understand how to best fit your other assets around Centrelink if it's something you're able to achieve. So let's carefully look at Centrelink. The first key piece of information Centrelink is looking for is whether you have simply turned age pension age. The following table illustrates your age pension. Anyone born before 1957 is now age pension age, being over 66 and a half. Anyone born after 1957, the age pension age is now 67 years of age. So that's the first hurdle everyone has to overcome, simply turning age pension age. Now that you've reached age pension age, the second piece of information is whether you are single or couple. There's a significant difference between the assessment of a single person and a person that is part of a couple. Finally, the last key piece of information that needs to be considered prior to being assessed under the assets and incomes test is whether you are homeowner or non-homeowner, such as a renter. A homeowner is generally exempt from, the home is generally exempt from the assets and incomes test, which is a significant advantage. Centrelink are aware of this significant advantage of exempting the home, so provide more favorable assets and income assessments to non-homeowners. Now that Centrelink have you categorized, they will apply the means test, which have two components: the assets test and the incomes test. Under the assets test, if you are single, a homeowner, and have assets of less than 301,750, you'll receive the entire age pension, 100% of the age pension. If you're a single homeowner and you've got assets outside the home of 656,000 plus, you'll receive no age pension. Or if you are non-homeowner and you've got assets of over 543,000 plus, you receive 100% of the age pension. So I should say under. And if you've got assets of over 898,000 plus, you receive no age pension. So that's how you would be assessed under the assets test. And it is a moving scale. So you move all the way from receiving 100% to none at all as additional assets accounted. For a couple, a similar test is applied with different figures. Under the assets test, if you're a couple homeowner and you have assets under 451,500, entitled to 100% of the age pension, and that cuts out to zero when your assets outside the home reach 986,500. Or if you're a non-homeowner, you can have assets of 693,500 and still be entitled to 100% of the age pension and receive nothing once your assets as a non-homeowner reach 1,228,500. But Centrelink isn't done with you yet. That was just the assets test. Centrelink now apply what's called the incomes test. It's important to know that not all income is income to Centrelink. So you must be mindful of what's called assessable income. Some of that income can even be deemed. However, you will be entitled to the full age pension if your income is on a fortnightly basis as a single person less than $204 per fortnight. And you'll receive no age pension as a single recipient if your income exceeds $2,332 per fortnight. And you'll cease receiving any age pension as far as the income test is concerned. Let's keep in mind as well, guys, that employment income to a point is favorably looked upon by Centrelink. There's what's called the work bonus, which lets you keep working and earn up to $300 a fortnight of employment income without your age pension being reduced. This is on top of the $204 you may earn each fortnight if you are single. And if you're a couple, you will be entitled to 100% of the age pension if your income is below 360, and no age pension if your income is above 3,568 per fortnight. As pension is reduced by 50 cents for every dollar over the incomes test. As mentioned, please keep in mind that employment income is, to a point, favorably looked upon by Centrelink. The work bonus applies to individual pensioners. It cannot be shared amongst a couple. The work bonus lets you keep working and earn up to $300 a fortnight of employment income without your age pension payments being reduced. That is on top of the $360 you earn each fortnight as part of a couple. So, after navigating all of those assets and incomes tests, being mindful of whether you're a homeowner, non-homeowner, your age, pension age, single or couple, what are you receiving from the government as the age pension? Well, the single age pension, inclusive of supplements, is $1,060 per fortnight or $27,664 per year. And the maximum age pension for a couple, inclusive of all supplements, is $41,704 per annum combined. Ensuring you are maximizing this important cash flow can have a dramatic impact on your retirement. Now, guys, let's see how financial planning can help improve Centrelink results. Here we've got our friends Jane and Joe. Jane's 65, Joe's 67. They are retired and recently downsized as the kids have moved away. The net result of this move is that they now have $986,500 left to invest sitting in their bank account. They have no other assets. Joe went to Centrelink because he went to a seminar and realized he was age pension age, left early without getting greater details, and was disappointed to find out that he wasn't receiving the age pension. They remembered my seminar. They gave being NES members, they know they're entitled to NES Super Financial Planning because it's part of the service, gave me a call and set up a meeting. After going through the initial consultation process, getting a clear understanding of what their situation was, what they were trying to achieve, the following recommendation was considered. What we ended up recommending was a combination of downsizer and non-concessional contributions placed in Jane's super fund of $535,000. The reason for this is that Jane is 65 years of age, and her super fund in accumulation mode is not counted for the assets test. In a sense, Centrelink are legitimately blind to that money. Now that Joe is under the assets test, he would be entitled to 100% of the age pension. So I'll be very clear, guys. Before they walked into my office and sought financial planning, they were receiving no age pension. After a meeting and then going ahead and implementing their advice, they go back to Centrelink and receive $20,852 from Centrelink. That's financial planning. That's what we do. That's what Teresa and I do. We just clearly understand what your situation is, the goals you're trying to achieve, and efficiently get you there. If I had to describe financial planning in one word, it's just efficiency. We just efficiently understand the rules, navigate your assets and incomes in light of your goals to make the most of what's available to you. So again, guys, 0 before the meeting, 20,852 after the meeting. So guys, we're at the tail end of our meeting. Was our mission accomplished? Do we have a better understanding of what super and super pensions are? Place to store your wealth. Place to store your wealth with a regular payment. knowing how taxation is affecting you and your retirement plans, knowing how Centrelink's means test work, which is the assets and incomes test, knowing the different asset classes you can invest in now in your retirement, knowing how financial planning can add value to your situation. Guys, tax, super. You've probably thought you had a few questions, and after the seminar, even having more questions. Should I sell my property? Should I wind down my company? Questions. I've heard of this great share. Questions. Maybe I should just put it in cash. It can be a confusing landscape, and good guidance, guys, can be incredibly valuable. Financial planning is all about you setting goals and us, the advisors, guiding you to the most efficient destination. We can help. You are members, you are entitled to financial planning. If it's financial planning in relation to what's called intra-fund advice and would guide you through this, it is part of simply being a member. So the advice is included as a member. If it's anything more complex than that, we incredibly flag it and ensure that you're aware of any potential fees. The vast majority of the advice we provide is very much covered by this. But there is no one size fits all when it comes to financial planning. We can help you navigate through Centrelink and the Australian Taxation Office. Topics we generally cover: retirement planning, transitional retirement, so you're moving into retirement, contributing lump sum or salary sacrifice into super, insurance, investment choice, discussions on debt. The solutions we're able to provide at NES is the super itself, the pension options that we have available, the insurance, which we weren't able to discuss today because it is a retirement seminar, but these are fantastic. We have a fantastic insurance policy for the electrical trade. It's very much tailored to that trade. I think it's one of the best out there. We have investment options. So we have a variety of places for you to store your wealth in relation to the 4 key asset classes. Guys, we've come to the end of our seminar. So the people online will be saying goodbye shortly, but these are our details on this particular slide. You can see that you can contact Therese or myself. So we have 2 financial planners on board now. We have, of course, the 1-800 number. And guys, we're here to help. So we'll end with the online presentation. Thanks, guys, for showing up online. Do appreciate it. And for those that are here, I'll quickly shut the computer off and answer any questions you have.